All right, let's go. Okay. Yeah, there's some more people joining us. Okay, so we I was looking for euro dollar to actually get a little bit higher, but that didn't happen. Okay, that didn't happen. Let me see the 15-minute here. We got caught in a consolidation area here. I was looking like that, you know, we could break this stop here, but in the end, this is a consolidation zone right here, let's say. Okay. So that did caught me off guard, because it was accumulating on this area, and then it was okay. Most probably we will have a move that will go above these highs, these ones here, and then from there we're gonna continue to this area here. That's a, you know, most likely a resistance area, and then retrace. Well, not retrace, but continue the downtrend, right? Because when we get off from the bigger picture, what is basically happening is pullbacks and continuation downtrend, right? But that didn't happen. And what happened was the opposite. You know, we braked through these lows. We tested first, and then we braked too. And then we came back lower, and then another high. So another pullback, and then another lower. But of course, everyone knows, like, simple to see that this is a consolidation phase. Why did this move happen? Okay. So we need to look at the chart and think, okay, so that happened for some reason, and this happened for some reason. These ones and these ones is pretty much no moves, so nothing happened, right? Or let's say, why did this move, like this huge move down happen? And or even this one, why did this 1 hour candle, that's a 15-minute candle, moved 0.6% in 15 minutes? Why did that happen? Or even this one, okay? So when it comes to trading, you need to ask, okay, so what did happen that I was wrong? Okay. Meaning price is most likely to go back up, especially with the US GDP coming out. I will get there. But let me take this off. So, following the thinking line here is that we need to understand those moves. Okay. Everyone is already guided to know that the euro dollar is basically a opposite of the US index. Okay. Everyone knows that, because the US dollar index is basically a basket of currencies. Okay. So if you search it up here, what is the US dollar index? It will say that it's a composed of it's a composed of the euro, the Japanese yen, the pound, the Canadian dollar, Swedish krona, and Swiss franc. And the majority being euro, having 57.6% weight, and then Japanese yen, and then pound, and so on. So that shows to us that whatever is happening on euro, 57% of the time is happening differently on the US dollar index, right? So if we come here to DXY, that stands for the US dollar index, we can see that it just happened the opposite. Okay, those up moves here were the down moves on euro dollar. Those down moves here was the up move on the euro dollar. Okay, so let's add up here euro dollar here. There you go. And if we take the US dollar index, okay, right here and invert the scale, invert scale, it's exactly the same. I mean, not 100% of the time, but let me lock this left. There you go. So look at this. It's majority of the time is completely the same. Okay, there's like a few spots with minor difference. Okay, so if we do this, that's most probably likely to have the effect we want. There you go. Okay, so look at those moves. I can even change the color. Maybe some purses don't look. There you go, white. Okay, and then the GXY will be in blue. So look at that. It's pretty much the same, right? And why is that? It's because the US dollar has a compose of 57% of the weight or on euro. Okay. That being said, let me come back. Candles. And then come back to euro dollar. Okay. Perfecto. That's a 15-minute move. It's a 15-minute chart. But that's the opposite. So there we go. So looking at here, what can we understand? We need to dig in further to see what actually happened. Okay. I look for a divergence between the two at a key level. Well, that can work as well. That's a very smart way actually to trade when you look to a divergency between US dollar index or, you know, even Aussie dollar. Australian dollar is already the same thing as the completely opposite of the US dollar index. Okay. Anyways, so coming back here, why did we had a move back and not a move up? Okay. Right. So it has started not today. It has started a few, well, yesterday. So basically 2 days ago. Okay. So there is a truth, as I can say, behind the US dollar. Okay. So let's go for the GXY until as I'm explaining this. So this move here, this move up, okay, let me check. So this move up here, all right, 2 days, 26, 27, not counting today, but 26, 27. We had a comeback, all right. We are up above the 106 levels that we couldn't breach before here. Okay, so we made this move down and now up. But that's the recovery was pretty much driven by some statements from the Federal Reserve Governor Michelle Bowman, which balanced out the comments made by some other federal officials on Monday and Tuesday. So Michelle was highlighting the ongoing uncertainty in the inflation outlook, because if we look to inflation rate USA, okay, we can see that the inflation is still kind of sticky. So the preview was 3.4, consensus was still to be the same, but then it came lower. That's good, but it haven't go below 3 since June 2023. So that's pretty much a year already. So let's go for 5 years. Yeah, since June 2023. So since June 2023, we haven't had a single month below 3, right? May 3.3, April 3.4, March 3.5, 3 on June. 3.2 in July and 3.7 in August, 3.7 September, 3.2, 3.1, 3.4. So basically, this is showing to us that inflation is sticky. So with all the things I've gave to you already, for everyone here in the live stream, what does that mean for a currency? When the inflation is sticky, what the central bank can possibly do or can possibly not do, and what does that mean for the currency? Do you guys remember? No, no one? Okay, not a problem. Okay, so when there is an uncertainty into the inflation outlook, it's basically suggesting that the rate cut that everyone was expecting from the Fed this year is somewhat premature. Okay. So when Michelle comes in and say, look, the inflation is the path of inflation is uncertainty, is that they're not expecting inflation to become lower. Otherwise, they would say, right? Because that's such a good that's such a good news. Why they wouldn't say that? Okay, if they know that inflation is supposed to come down, why then wouldn't come to the meeting and say it forever? And look, we have done a projection and forward guide and forward path of the inflation is looking great. We're expecting inflation to reduce from 3.2 to 2.2 in the next 1 year, but they haven't said that. All right. Well, they did say that, but not as confident as all the central banks. You know what I mean? So, okay, coming back. So pretty much she has been very hawkish, and she has used a very hawkish stance that basically is showing that her expectation that the inflation will remain elevated for some time. That shows that there is some hawkish comments going on the Fed decisions, and that she's not expecting the Fed to cut the rates anytime. So she's basically saying to us that the Fed won't cut this year. Okay. Now, if we come to the CME, Fed Watch 2, let's just wait here. Okay. We can see that, of course, 31st of July, no one is expecting a cut. 18th of September, 56% of the market is expecting a cut. And the rest is, sorry, come back. And the rest is not, the 37% is not, but the 6% is expecting 50 base points cut. These ones are, this 56%, the majority is only expecting 25. Not only, that's already a big move, but anyways, compared to those ones, the 6%, there everyone is expecting a 50 day. And then on November 7, 50% of the market is expecting no cuts, because remember, when they cut here, 56% will, let's say they do cut, then it becomes 5 to 5.25. And then here, they're expecting no changes from there. And the current target rate is 5.25 to 5.50, all right? And then 18th of December, they're expecting 42% of the market is expecting another 25 base points. So still reflecting on the 18th of September and 18th of December, they're expecting 25 base points cut each. So we would be coming all the way from 525, 550 down to 475, 5%. Okay, so 50 base points cut, so 0.5% of a cut. That's what the market is waiting, the overnight swap rates are expecting. Now, don't take this as a 100% tool, okay? Because it's not. It can change it minute by minute, because it's basically the market. How can I explain this? So it's pretty much the CME. It's the CME group comes to big investors and ask them, look, what do you think about the market? What do you think about the Fed rate cuts? Do you think they will cut? When and so on. So, and then it comes here and then it shows to us. Anyways, so coming back to the US dollar index. So these, if they do cut 2 times, okay, if they do cut 2 times, that would be not good for the US dollar, okay? But one thing that is triggering me is if the overnight is pricing 2 cuts in the 18th of September and 18th of December, and then Michelle Bowman, I don't know her name, Michelle Michelli, comes and say, look, the Fed won't cut, and the market reacts much better to these than to both cuts. It just shows that the market don't want the Fed to cut 2 times. Okay, the market is listening to hawkish comments from the Fed. So the market is more inclined, as I can say, to listen to more of a hawkish comments than dovish comments. Okay, that's what I've been thinking about it, and that's what I've been researching. Okay, now everything comes down tonight for the GDP. Okay, because we do have the GDP in a few hours. So let's say today, that's not my time zone. There we go. So there we go here. So we had at 10:30 p.m. tonight, the GDP quarter one. And let's open up. The forecast is at 1.3. All right. Why did the actual came at 1.3? May, last release May. Oh, okay, that was the what? Anyways, oh, okay. Oh, right. Okay. Imagine if we could get this inside information. Anyways, so last time, the market was expecting 2.5 and it came in at 1.6. Then the market was expecting 1.6, it came at 1.3. And now they're expecting no changes from the 1.3 to 1.3. So they're expecting again 1.3, and it will probably come lower. Okay. And that's what the Fed has been saying. Okay. So GDP, Fed, I'm gonna have to find it out. I'm gonna go Federal Reserve, and then that was in 2023 in June. HTML. Oopsie, not this one. HTML. June. There we go. Press conference. Projected materials. HTML. GDP 24. Change in real GDP 1.1. March projection 1.2. Okay, so that's the number I want. So the change in real GDP, they're expecting to be 1.1. That was in 2023, in June 2023. Let's have a look now in June 2024, this one. So right now, change in real GDP, oops, there we go, 2.1. So they were expecting 1.1% of growth, okay? The central tendance was between 0.9 to 1.5. And the range was between 0.5 to 2.2. And now they are expecting basically more than the range. Okay, that they actually put the range, but they're like, okay, no, we're expecting now more than the range. And The central tendency is between 1.9 to 2.3, and the range is now 1.5 to 2.5, 1.5 to 2.5. Well, they've pretty much put 1% in everything higher. Okay. I don't know if that's good or if that's bad, because yeah, that's really not good. A hawkish Fed combined with the uncertainty of the French elections, would that indicate euro going lower? You just nailed the dot, Steve. It's completely right, man. And I was about to talk about that, but I was just trying to find a document that I was looking to find it, but anyways, I can't find it now. Yes, so when we look to euro dollar right now at this scenario, we can probably look at euro dollar a bit higher, because if GDP comes lower, then therefore we may have the actual lower than the forecast. We may have a weaker dollar, and then the euro can probably push up to these highs or even on these highs. That's very possible. Okay, that's very possible. But again, this is not a investment advice for anyone. I'm just talking about possibilities here. So going ahead here, right? The government Bowman, Michelle Bowman, she annual vote on the FOMC gives her a position as a very influenced person, because she can vote into the FOMC. Or she can say, I want to cut, I wanted to hike, I wanted to pause again. And she has been very consistently hawkish, and has been anticipating the previous views, I would say. Okay, so she is one of the 4 FOMC members opposed to rate cuts this year. And she's very well known about this position. Okay, but what I want to say is it's her, all right, and another 3 people. So another 3 people are not expecting cut. They are not trying from FOMC, right, inside of FOMC. So they don't want to cut. And the rest 4, they are looking to cut. So it's pretty much, if someone changes the mind, then we're not going to have cuts. Okay, if inflation comes higher again, most probably we won't have a cut. Okay, because it's only another person. If we only have another person from the FMC saying, look, I think inflation is too high, I think we need to have a higher rate, and I will consider to maintain my vote as a pause, then it's going to be like, okay, so we are 50-50. So 4 people want to hike, 4 people don't want to. 4 people want to cut, 4 people want to pause. Let's do rock paper scissors. I'm joking, but it's going to be very, very intriguing. Okay, so in contrast, I don't know if you guys know the governor Lisa. She offers a little bit more of a balanced perspective. All right, she acknowledged the need for a rate cut, but she says at some point. All right, at some point, while she is of course expressing the cautions, because she believes that the inflation would stabilize sideways, and that's exactly what is happening already on the inflation. It's completely sideways. It goes 3.7, comes 3.2, 3.5, 3.2, 3.3. Okay, so that's sideways. We can see. Where's my pen? There we go. We can see that. Oopsie, that's in white. I need another color. We can see that inflation is on this band. Okay, pretty much on this band, and even on this band. Okay. So she thinks that inflation would stabilize sideways at as going to this year. So she also is predicting a more significant declines in inflation, but only in next year. And that's where she believes a rate cut would be possible. And that's why she say at some point. So a very neutral to dovish person, okay? Comparing to Michelle, a very different perspective, right? As Michelle say, like, look, inflation will go higher. We don't, I don't think that the cut would be a smart way to do this year. Again, there's so many views, from the Fed officials, and they're pretty much highlighting two key points. Um, the the first one is the diverse opinions within the FOMC on the pace of inflation decline, and of course the significant impact of the economic data on the market movements, and the recent market reactions to the CPI data as well, and the shifts that these have made on the FOMC rate cut projections. It's pretty much illustrating to us the dynamic of the market. And that's exactly what I've just presented to you guys, the dynamics that is happening on the market. Okay. So this week it's going to be, as I said on Tuesday, we don't need to expect anything crazy. It's more like a consolidation week. We do have some major movements anticipated for next week, because everyone knows that's when we're going to have the PC inflation data and the NFP report. And the NFP data will be very, very crucial as well, especially given the Fed president, Mary Dialis, if I can't remember, I think that's her name, because she made a comment about the inflection points in the labor market. Okay, so pretty much she's indicating the increased risks of the downside surprises. But the US dollar could see, all right, let me come back here. The US dollar could see some further gains, particularly if the weekend's political developments align with market expectations. But however, the significant movement will depend, I guess, on the next week data, all right, especially regarding the NFP and the labor market conditions. So that's my view on the US dollar. It's, it could potentially go up this week because of the comments, but as well, I'm expecting much more movements next week. All right. Okay. So that has been said. Let me take all of this off. Now, Steve has sent us a message here, and he said that a hawkish Fed combined with the uncertainty of the French elections, would that indicate euro going lower? You're completely correct. Okay, that's the way you should be thinking when you look to economics. You should be looking at, okay, euro as a Europe, as the Eurozone, what is happening on Eurozone, and what is happening on USA. Anything political impact and geopolitical impact, or even monetary policy impacts, will impact the currency. Okay, so if we do have a hawkish Fed, but it's not a Fed, it's one of the members from the FOMC. Okay, so the FOMC is the Federal Open Market Committee. That's where they make the committees about the rate decision. And the Fed is the one that sets the rates. Okay, so the FOMC, it's pretty much how can I say to you? It's someone that gives an advice for the Fed. Okay. And then from there, the Fed just believes on the device and follows through. But yeah, we do have a neutral Fed. We don't have a hawkish Fed. We have comments inside of FOMC that are hawkish. Okay, just don't misunderstand that. And yes, combined with an uncertainty of the French elections, that everyone is believing of a Frexit. I don't know how they. I really don't know how they say Brexit, exit. Anyways, so people are not believing much on that, but it's still a murmur that is going on the market. So there is a possibility. Okay, there is a possibility, and we have to play with those possibilities. So yes, looking for some hawkish comments inside of FOMC from the committee members, combined with a French election and instability, uncertainty, as I could say, that's definitely a good couple, a good combination for a big disaster on euro dollar quote. Okay, so let's have a look on euro dollar. If it loses this ground here of the 106.67 tree, we could potentially see euro dollar coming to the next levels of 105. Okay, that I have been talking about this for a while already. Okay, there you go. And to be very honest, that does look like a small consolidation for a continuation lower. Okay, just, you know, being very, very transparent with everyone here. So that would be a good trade. Okay. Any questions on euro dollar? I think I've break down like everything here, but does anyone have any questions? No questions. Okay, let's move on then. I want to talk about another thing as well, Aussie dollar. Okay. Let's get these countries. Let's go for Australia, G10, G20. There we go. Inflation rate. Okay, there we go. Okay, here. All right. So, you know, looking at Australian dollar outlook, everyone was asking me last Tuesday, and then we didn't have much talk about Aussie dollar. But Australia did had the last inflation data did raise some concerns for the RBA, potentially leading to a rate hike, I would suggest, at the next meeting on next week, I think, August 6th. Let me check what day will we be. Oh, don't have access to my calendar here, but anyways, it's on August 6th, the next RBA meeting. The year over year, the CPI for May, we can see here that it increased for 3.6%, and the consensus was expecting 3.4. Okay. When we see these, oh, sorry, that's quarterly. Let me go for yearly. Can I check here? Inflation. Well, that's what, a month of a month. That's inflation. That's the only inflations. Yeah, that's the only inflations we got. Huh, interesting. Okay, we can work it on with this one. That's better. All right. So when we see this kind of shape on the inflation, we call this the V move. Okay. So up and then down. We have the U shape, something like that. And then we have the V move, that is this one. And then we have the N move, W move, sorry. That's this one. Okay. So what is happening right here is the V move. Okay, so we can delete those two. I wouldn't suggest that this is good. Okay, because let's take in consideration we had 3% in quarter 3, 2021, and then we went all the way to 7.8 in Q4 2022. And then now all the way down to 3.6 in Q1 2024. So we're pretty much from 3% in Q3 2021, very close, 0.6% of a difference here. So that suggests to us that a very high rise on inflation, back with a high impact on the lower side of inflation, and that shows to me that, okay, they've raised the rates so aggressively that now the economy is feeling it quarter over quarter. Okay. Okay. So as we can see, it came in higher than expected. Okay. From 3.6 to 4%. And the trimmed mean measure rose from 4.1 to 4.4. So both surprised the expectations. And this data has driving up the 2-year government bond yield and weighted market expectations for potential rate cut. Let me take this off and show to you. Let me see if I have it here. Oh, I have it here. There we go. As we can see, right now it's at 427. And if we look, oopsie, right now is at 4.35. Okay. So if that goes above this guy here, we are gonna hike. Okay. Most probably 4.35. Okay. Oopsie. There you go. Okay. So that's what I'm, looking at these. It tends to be like that. The rates tends to follow the 2-year government and 10-year, anyways, the government bond, okay, yield. And we just saw from, it has drived up the 2-year and it has weighted on the market expectation, okay. Anyways, the policy meeting on June 18 that we had, the RBA governor, what's his, it's not Michelle. Is it Michelle? Because I think we had a change. So wait a minute, let me think about it. It's yeah, it's Michelle, because before it was Philip. Yeah, so that's Michelle. Yeah. So Michelle Bullock, he indicated she indicated a leaning towards a rate hike. So she also noted the restrictive nature of the current scenario, of the current monetary policy, and a very weak economic data as balancing factors. The last influence figures, however, made it very difficult for the RBA to ignore the case for a rate increase. So they can't even ignore it, because when we look to it, we already know that inflation is so much high. It came in much higher than expected. It has increased the 2-year notice bonds, okay, the T bonds, government bonds, that they can't just put the hands on their eyes and say like, oh, okay, we're not seeing this and that's going to be fine. Look, the timing of these data is critical, okay, and it's coinciding with a planned fiscal stimulus from the government as well. Michelle Bullock, she has emphasized the need for more comprehensive inflation information before making a final decision. With no RBA meeting in July, okay, the next key data point will be the Q2 CPI release on July 31st. For a Forex perspective, when we look to these, the scenario is pretty much supporting a higher yield, and it's pretty much suggesting a gradual upward movement for the euro, for the Aussie dollar. Okay, so if we go here, Aussie dollar, where is this? So, yeah, there you go. We can probably see a breakthrough here. Okay, but then that would only happen if we actually see the RBA coming in and say, look, due to increased inflation and due to we don't have a path for inflation, we don't know what's going on, we're going to hike another 25. Okay. I don't think it would, but there is a possibility. Okay, that's what everyone is talking about. Every economist on Bloomberg, some Citadel economists. I don't think so, but if you know, if there is a possibility, then why they wouldn't as well? Okay. Okay. Now, next, let's talk about gold. It's a 4-hour chart. Go to 15-minute. I've been predicting all of these moves. If you guys don't know, I think everyone here knows, but look, we have a YouTube channel, and I've posted a video. This one here. Hello guys, welcome back to another. Let me take the audio off. And I've mentioned about the 2,280. So that's the support at 2,280. Okay, so let's put it here. Oopsie, sorry. There you go. So that's where I believe my target is. Okay, so that video I've posted 1 day ago. So that was in Wednesday. And I've made the video when the market was somewhere around this area. So you could potentially catch up this move here. You know, but we're very close. We're very, very close. All right. Some people doubt about it, but we're very close. All right. When you look, the market has been, of course, in a range. Okay. Let's say for 4 hours. Let me come back. When you look for 4 hours, it can be potentially in a range. Yes, but we are very close to break this range. Okay, very close. It's not even a range. I wouldn't call this a range. I would call this a pullback, right? And if that was, you know, what everyone is thinking, that could potentially come back. But my projections are down. Okay. When it breaks low this point, if it breaks below this point that I've just mentioned, the 2,280, I will do some projections, but I guess the level of 2,190, 2,200, of course, that would be a good stop. But then afterwards, 2,150, 60, that would be the next fractional point. Okay. All right, so we have a few more questions. So from your YouTube upload today, I guess AI trading systems would analyze all of the figures you have presented, but how would AI consider human sentiment of a certain election outcome? That's a really, really good question. We don't have much time to talk about this today, but I definitely will remember this for Tuesday. But okay, so let me be very briefly here. Does anyone have any more questions regarding the gold, regarding Aussie dollar, and regarding euro dollar? Okay, so as we wait for Switzy question, I'm gonna talk with Steve here and for everyone as well. So there is something called human sentiment machine learning. Okay, so if we look here, human sentiment machine learning. It's sentiment analysis and machine learning. So Euro-dollar trend isn't likely to change even if the GDP comes out lower, would it? Yeah, but that's exactly what I was talking, Switz. Because if we look at euro-dollar, there is a possibility for this to come back. Look, there is a possibility for it to come back, okay, as on a range. But then I look at these and I think, okay, that's where it should probably go. And that's my opinion. But yes, if it comes lower, then potentially it could go up. But in the next 2 weeks, in the next week, we're gonna have the NFP. And if NFP comes higher, then whatever happens with the GDP today doesn't count anymore. You know, so the market tends to believe more in stronger data than weaker data. I tend to believe. So yes, that's what I think. Okay, so coming back to here, we have a sentiment analysis that so basically you give samples of analysis for emotional text, okay, emotional texts that can be felt, can be read, and then you can express something through, okay, I don't believe this is gonna happen. That is a sentiment of equals to anxiety, equals to curiosity, equals to whatever. Now, based on the market sentiment could be something around those lines as if Biden gets the elections, then da. So if Biden, and then there's something. So that something is an emotion towards an objective through an object, for a object and through a perspective. Okay, so therefore you could play around with those machine learning and try to catch the best possible way for having a better outcome. Okay, so yes, there are some ways you can implement that. They're very hard ways, but there are some ways you can implement that. That's for sure. What else did you have? Let's call it, but how would you AI consume? Yeah, I think that was the question, right? All right, guys, we have come to another end. I hope everyone liked it today. I did prepare myself quite a bit. Not a problem. Thank you, Sweetsy. Thanks, Steve. Not a problem. All good. And I see you all next Tuesday. And I hope everyone have a lovely weekend. Take some time, spend with your family, friends, and go walk on a park, do some activity, and we'll be back on the screens next week. All right, guys, have a good one. Talk soon. Bye bye.